slightly tough news for Indian investors. The question is how to prepare yourself for it. We tried to discuss that with Mr. Sunil Subramaniam. Let's get in Nisreen Mamaji. She joins in right now to talk about her thoughts on this, and then a few other topics that a lot of you have requested for, and we'll try and talk about all of those. Nisreen, the first time that we're having you on the Mutual Fund Show, welcome. Thanks so much for joining in, and thanks for taking the time out.
Thank you so much for having me. It's a pleasure to be here, Niraj.
Thank you. So, Nisreen, just quick thoughts here. I don't know if you got a chance to hear everything Mr. Sunil Subramaniam said or no, but what are your own thoughts? If investors want to prepare themselves for possible, global market strength, but simultaneously maybe some weakness in the Indian markets, is there a way that investor can prepare herself for it?
Okay, so basically we're looking at an investor, say who's investing for more than 5 years or less than 5 years. I break them up into two categories, and also depending on their risk tolerance. So if your time frame is about say less than 5 years, you should be looking at some amount of debt, of course, and a diversified fund. So what I would recommend is for a category of less than 5 years, you can be looking at maybe a special situation kind of a fund, which would take advantage of movements because of tech disruption or regulatory framework, etc. A fund that I could recommend is the ICICI Prudential Business Cycle Fund, which is based on these themes and is currently invested into corporate lending, banks, infrastructure, and metals. If you are, a little bit, your risk tolerance is a bit lower, you can also go for a multi-asset fund, which would include gold, international equity, debt, as well as domestic equity. So possibly a recommendation could be the Motilal Oswal multi-asset fund, which is currently about 63% in debt and 11.5% in international equity. Also, I would look at, say, if your risk tolerance is a bit on the lower side, you can look at index fund, which would be basically a passive strategy, which would be mirroring the index. So any of these kind of funds or strategies for various types of risk tolerance investors would be okay. But if your term is, if your tenure is more than 5 years, you could always look at a large and mid or a small cap category, because in the longer term the volatility tends to get evened out, and you could participate in the potential of higher returns by going in for either a small cap fund or a large and mid. So that could be possibly my recommendations for that question.
Let's assume there is a risk-averse investor, Nisreen, who wants to invest with a period of, say, 10 years perspective.
Right.
And in a really long term, even the riskier part of the equity side does well. But the investor is risk-averse. What would you recommend? A large cap equity fund, a flexi cap fund, or even if the investor is risk-averse, it's okay to go out and buy maybe a good small cap fund as well. And why?
So for, maybe for a less than 10-year category, I would suggest, say, a multi-cap. Multi-cap which has a large cap bias. So, you are not going to miss out on the possible potential returns of a mid or a small category. At the same time, because you're risk averse, say 70 to 75% of your investment will still be in a large cap. So the possible choices could be Canada Rubico Flexi Cap Fund, which is currently about 74% in large caps, or the Parag Parekh Flexi Cap, which is about 71% in large caps. So that way, you won't have too much of volatility, and your risk tolerance would not be crossed. And if you are investing for the longer term, then definitely you should be looking at a little more of mid and small caps, because otherwise you'll miss out on the rally and the outperformance potential of a small cap or a mid cap category. So maybe in a small cap, I can recommend the UTI small cap, which has got recently, it's recently launched, and I think that you could possibly see some outperformance there. In the mid-cap category, one can look at the Axis mid-cap. And also, I think that you should also be looking at a value strategy, because in the longer term, a value investor will possibly do better. So one of the funds that I could possibly recommend is the L&T India Value Fund.
You don't foresee any risk with a newly started fund. Wouldn't an established fund with a track record be better on the small cap side?
So basically, performance is not the only, criteria when you select the fund.
Okay.
So you would also look at the processes, the people, and the AMC itself. So since UTI has already been in the industry for so many years, the fund manager himself is managing various other, even the UTI equity fund, which is now called the FlexiCap fund. So therefore, I would think that I typically would not recommend an investor to only look at performance, while you're making that selection. So even if it's a new fund, you can yes.
Got it. Fair point. Final question, Nisreen, and that is a lot of people have been sending this about how they want to know that if indeed rates in India were to go up,
right?
How is it that they can take advantage of that phenomenon via use of mutual funds? Do you have any thoughts here?
Yeah. So basically,
if let's assume the investor believes that rates will move up. So we're not asking you whether or not rates will move up. The hypothesis is that the rates will move up, and therefore,
sure.
How can an investor take advantage of it?
All right. So one thing is that if you can be invested in various strategies, if you go in for the shorter end of the yield curve, so say a medium-term plan, which is at about 2 to 3 years is the tenure, the duration of that fund. You would be able to manage the interest rate volatility. With the interest rates going up, the yields will go down. There's an inverse proportion between the two. Another strategy could be an accrual strategy. So maybe if you are in a credit risk fund, which is purely, going to be an accrual, whereby you would, get what you are promised. In other words, the YTM, the yield to maturity, could be an indicator of what to expect, and you wouldn't take too much of a risk. Or you can also, with the interest rates moving in this fashion, also go in for something called an equity savings fund, which would have about 15% of equity. So, of course, if you are introducing equity in this category, then you have to have a slightly higher risk tolerance and you have to be open to a little more volatility. But I believe that this could be a good option. The equity savings category could be a good option to a fixed income investor. And if your risk tolerance is even a little more higher, then you can go for something like a dynamic asset allocator, asset allocator fund, whereby the fund manager himself will decide the proportion of debt or equity into this particular fund. So say currently the ICICI Prudential Asset Allocator is about 36% in equity and the rest is all in fixed income. So whereby, you don't have to keep on churning the portfolio or rebalancing the portfolio. You can leave it to the experienced people to decide whether they need to be in equity or debt. But bear in mind that with equity, your risk tolerance should be a little higher. So if you're purely a fixed income investor, I think maybe the shorter end of the yield curve would be safer for you, and also to go just with an accrual strategy.
Right on. It's been lovely having you. Thanks so much for taking the time out, and look forward to having you more often on the show.
Sure. Thank you. My pleasure.
And viewers, thanks for tuning in to this leg